Intuitive Surgical is currently trading at $446.13. That's a significant move up of $11.51 or 2.65% just today. The market sees this 2.65% jump and immediately celebrates. The king of robotics is back, the moat is secure, and all is right in the world of medtech. But this immediate celebration, this sigh of relief, is missing the real story. What's actually happening under the hood is a subtle but critical divergence in the data coming out of hospital channels. Today's price action is a short-term reaction, but the long-term question is whether the incredibly high-margin instrument sales, the real profit engine, can continue to accelerate at a pace that compensates for the new, very real softness in new system placements. Hospitals are feeling the pinch from high interest rates, and that $2 million capital expenditure for a new Da Vinci is a much harder decision today than it was 2 years ago. Let's be clear, the general consensus on Intuitive, ticker ISRG, is perfectly understandable. For the better part of 2 decades, this has been the ultimate growth and quality story. It's the kind of stock you buy in your Fidelity brokerage account, or maybe it forms a core part of your Schwab and Intelligent Portfolios allocation, and you just don't worry about it. It's the Apple stock of the operating room. It has a beautifully closed ecosystem, ridiculously high switching costs for surgeons and hospitals, and a razor and blade model with its disposable instruments that just prints profits quarter after quarter. The expectation has always been that this dominance is permanent. But that expectation, the one that justifies its premium valuation, is starting to look a little dated. Thinking ISRG is a buy-and-forget stock right now is a significant miscalculation. The reality is that the impenetrable moat everyone talks about is facing its first real multi-front assault. We are no longer talking about small niche startups. We're talking about giants like Medtronic and Johnson Johnson, who are finally getting their own advanced robotics platforms approved and placed into hospitals. While they aren't Da Vinci killers today, they are successfully beginning to target the lower acuity, more cost-sensitive procedures. Think basic hernia repairs or gallbladder removals. These are the very procedures Intuitive needs to capture to justify its next leg of growth. So while today's 2.65% jump feels validating, it's actually masking this much larger, more foundational competitive pressure that is building just beneath the surface. Let's really break down today's $11.51 move. This didn't happen in a vacuum. Looking at the intraday tape, we saw a heavy volume spike right at the opening bell, which suggests a large institutional block trade. This is often the footprint of a large fund rotating. Perhaps they were trimming some of the high-flying, volatile names like Nvidia stock after its massive run, or stepping away from the sentiment-driven chaos of Tesla stock and moving those allocations into what they perceive as safer growth. Medtech, and ISRG in particular, is the classic recipient of that rotation. The stock has been building a solid technical base around the 430 level for the past 2 weeks, and today's move appears to be a technical breakout above that near-term resistance. However, if you're using a real Fidelity trading platform or the advanced charts on interactive brokers, you'd notice the relative strength index is now pushing north of 70. This is textbook overbought territory in the short term. It suggests this rally is getting a bit hot and might be due for a pause or a pullback. The volume is solid, better than the 30-day average, which gives the move some legitimacy, but it's not the kind of explosive all-in accumulation day that signals a major new consensus. It feels more like rebalancing. This is the kind of detail that gets lost if you're just glancing at the Robinhood app and seeing green. When you're managing your own individual brokerage account, you have to decide, is this genuine conviction, or is it just the stock's turn to catch a sector-wide bid? Now think back to their last earnings report. The headline numbers were a beat. Revenue and EPS ticked just above Wall Street estimates, and the stock popped. The expectation was set, business as usual. But the reality was buried in the management transcript. The tone on new system placements was noticeably cautious. They used phrases like elongated sales cycles and capital budget constraints, which is executive speak for hospitals aren't buying new robots as fast as we'd like. They did guide well on procedures, which is fantastic for the high-margin recurring revenue. But this is the critical distinction. The market expects dual-engine growth from both new systems and procedure-driven instruments. The reality is that for now, only one of those engines is running at full throttle. Hospitals are opting to use their existing Da Vinci systems more intensively, running them evenings and weekends rather than buying new ones. This is a subtle shift, but it has major implications for future growth projections. I've been watching the 13F filings to see what the big institutions are doing. It's fascinating. While major growth funds like many Fidelity mutual funds or broad Fidelity ETFs remain overweight, they have to be, given ISRG size, there has been a noticeable pattern of trimming from more valuation-sensitive hedge funds. They aren't selling out en masse, but they are modeling the impact of competition from Medtronic and J&J far more aggressively than the sell-side analysts. It seems the smart money is hedging its bets. They're holding their core position, but writing call options against it or buying puts. This is the kind of sophisticated investment strategy that's hard to replicate for a retail investor, but it tells you the institutional conviction isn't as ironclad as the stock price might suggest. It's a core holding for many Fidelity wealth management clients, but the advisors are likely having to field more and more questions about the competition. For those who are newer to the story, let's quickly cover the business model, because it is brilliant. Intuitive Surgical essentially created and then cornered the market for robotic-assisted, minimally invasive surgery. Their Da Vinci system is a multi-armed robot controlled by a surgeon from a console. First, they sell this main system to a hospital for anywhere from $1.5 to $2.5 million. That's the capital sale. But the real genius is what comes next. For every single procedure performed, the hospital must use proprietary single-use instruments and accessories. These instruments, which cost thousands of dollars per surgery, have incredibly high gross margins. On top of that, Intuitive charges the hospital a hefty annual service contract for maintenance and support. This razor, blade, and service model creates a locked-in customer and a predictable, growing high-margin revenue stream. For over a decade, anyone using investing sites for online investing saw ISRG as a top-tier performer, a foundational holding for Fidelity IRA, and a key reason for MedTech's outperformance. The expectation was that this perfect model would simply run forever. But, as we've established, that forever narrative is now being tested. The reality is that the key patents that gave Intuitive this iron grip are expiring or have expired. This is the moment competitors with their massive R&D budgets and existing hospital relationships have been waiting for. Medtronic's Hugo system and Johnson & Johnson's Ottava platform are now in the field. The expectation from ISRG bulls is that these systems are clumsy, years behind, and that surgeons trained on Da Vinci will never switch. The reality is, they don't need to be better than Da Vinci, at least not at first. They just need to be good enough and, critically, cheaper. Think about it from the perspective of a hospital procurement officer. They hate being locked into a single supplier for anything. They are desperate for a viable second option just to give them negotiating leverage. A hospital system that already has a deep, multi-decade relationship with Medtronic or J&J for thousands of other medical devices, stents, sutures, staples, is going to be very, very receptive to trying their good enough robot, especially for simple simpler procedures. This is market fragmentation. Intuitive will almost certainly keep its dominance in high-end, complex surgeries like prostatectomies and thoracic surgery for years, but its total addressable market is being systematically nibbled at from the bottom. This is the kind of deep analysis you need whether you're a self-investing pro on interactive brokers or just getting started with SoFi active investing. You can't just buy ISRG on SoFi or Robinhood because you've heard of the Vinci robot. This brings me to a key question, and I genuinely want to see your thoughts in the comments. Comment below. Do you believe the new competition from Medtronic and J&J will actually take significant market share from Vinci in the next 3 years? Or is Intuitive's moat simply too strong and their ecosystem too sticky? Let me know what you think. So, what is the bull case from here? What's the catalyst that could re-accelerate growth? It's all about innovation and new markets. The expectation is that Intuitive's next generation system, the Vinci 5, will be a